Hello, everybody. This is Ted Bauman here, editor of Bauman Daily. This is your Money Matters. You'll be seeing this on Monday. We're recording on Friday. So if anything dramatic happens over the weekend, we can't be responsible for that, and we'll just have to see how it goes. Just so you know, if you haven't seen already, I'm working from South Africa. This is my office. Clint was just saying how beautiful it is. If you want to know why I'm here, here's a picture that shows a kitchen that used to have two big walls. No longer does, but this past week I've been overseeing demolition and rebuilding. So I have a legitimate reason to be here because this is my house and I'm fixing it up. But today what we want to do is talk about the collapsing house, which is the inflation interest rate story. Here's a chart that shows the most recent change in the consumer price index. And it's just we're in pretty significant territory. I mean, there's no question about it. I mean, I think the notion that this was primarily supply chain driven, which I adhered to for a long time, is wrong in the sense that it's not just that. There's more than that going on. And obviously, when we're getting up to 7.5% year-on-year inflation, that is very significant. Now,
highest level in 39 years, right?
39 years, yes, that's a long time ago. A lot of investors will have never experienced this. A lot of people watching today. So the thing is that the futures markets, which are kind of what bond markets are predicting that the Fed is going to raise rates possibly by 0.5% in March. And James Bullard, the president of the St. Louis Fed, says he wants to raise it by another 1 percentage point in July. So that, he's like the boogeyman of the bond markets. Whenever he opens his mouth, it's guaranteed to cause trouble. But here's what happened. The Treasury yield spiked. The 2-year Treasury, that's the short-term inflation expectation. And that's a dramatic jump in 1 day. So the market reacted very strongly, both to the inflation print and to Bullard's comments. But I want to show you one more chart before I start addressing today's topic, and that is a look at the 10-year Treasury yield going back to the mid-90s. And what I wanted to show you here is that what matters is not the absolute level of the 10-year yield, it's how quickly it rises. And that's why the market is panicking. I've circled or highlighted 3 periods. One is the run up to the dot-com bust. And the key thing is to look at the rise of the 10-year yield, but also to look at the MACD, which is the moving average convergence, to show you how rapidly that rise took place. And another one happened in 2013, early 2014, the so-called taper tantrum, when the Fed tried to pull back on its asset buying. That also caused eruptions. And so right now, if you look at that moving average convergence in the bottom right-hand corner, the danger is that we're moving at the same rate of speed. And that's the big concern. It's the absolute level, you can deal with it. It's how quickly it happened. That's the implication for the stock market. But let's just remember a couple of things before we talk about today's topic, which is 2 ways that you can beat inflation and high interest rates, 2 investment strategies. One is that that yields are still negative, even after these increases when you take inflation into account. So that's one thing a lot of people tend to forget. But the critical thing is that if yields are going to be rising and inflation is rising, money is going to flow into companies that can cope with that, that can sustain earnings and can sustain margins. And that's what we want to talk about today. Now, one of the things to remember is that we've had historically high margin growth. Here's a chart that shows margin growth going back to 2001. And, margin growth is basically, the growth in profitability of a company. And 2021 was an incredible year. It stood out from any previous ones, largely because of the low baseline the previous year. But nevertheless, there were a lot of things that allowed some companies to make a lot of money. And the problem is that's not going to happen for everybody next year, because that's happened already. The transition from 2020 to 21 is not going to happen twice. So the critical thing we really want to look at here, folks, is that there is a distinct possibility that we could see a big rotation in stocks away from what we have been enjoying so far and into something different. And one of the big drivers of that is going to be that companies that cannot basically reduce their input costs, which are the inflation costs, are going to get hammered, because basically they're going to end up in a situation where their earnings are going to suffer because they're paying more for labor, they're paying more for inputs, et cetera. So the one group of companies that I think will do well, and here I'm kind of anticipating our conclusion, is that companies that don't have a lot of labor costs. So software, if you can find software companies that are making money now, that have growing margins and rapid growth and low labor costs, because remember, software is great. You write it once, you maintain it, you sell it, your variable cost of production is extremely low. So go looking for software. That's one recommendation, and any other company like that. The second one is companies that have pricing power. And here's two charts from the Economist. And it shows on the one hand, the segments of the market. If you see me looking that way, that's because we're my other monitors. It's the segments of the market where companies can increase prices without losing sales. And it's what's called basically price inelasticity. That's what economists call it. If you need to buy milk and you can't live without milk, if they raise the milk price, you're going to buy it anyway, right? And there are a lot of things like that. So consumer staples, communication services, what are you going to do without telephone, without internet, information technology, particularly things like anything having to do with broadcasting, all the kind of stuff people depend on. Consumer discretionary, to a certain extent, for example, down here, I'm paying higher prices to do the renovations that I would otherwise, but I'm doing them anyway because life's short and you got to do it. So the critical thing is that these kind of companies tend to be more profitable in an inflationary environment, and that's the right-hand side of this chart. So you can see that as the inflation rate rises, the kind of companies that have bigger margins, better margins, and stronger pricing power are the ones to look for. And the last chart I'm going to show you before I turn over to Clint is a chart that shows Chipotle versus Clorox. And the reason for this is because when Chipotle had their recent earnings call, they basically said, look, we raised our prices and we kept selling burritos because people love burritos, right? Then there's no alternative to us. We are the fast food burrito company in America. And so
you can speak to that. My family can speak to that for sure.
They can speak to that. You can say, anyway, so basically that is, but Clorox on the other hand is not the only producer of bleach and cleaning chemicals. So they, on the other hand, when they reported their earnings call, their CEO said, we've had several periods of having to live through inflationary scenarios, and it took us about 12 months to reorganize things so that we got our margins back. That's what you need to look for, folks. Look for the companies that can price their way into maintaining and growing their revenues versus those that can't, because that's the world we live in. Clint, what do you got for us?
My family could single-handedly keep Chipotle and Target in business. I think that's for sure. So another way to combat inflation impacting your investment portfolio is to look at dividend payers. But not all dividend payers are created equal. And I'll get to that in just a moment. First thing I want to show is just how important dividends can be to total returns. I think investors, it's easy to lose sight of that for, the better part of the last 12 years or so, just because price appreciation from earnings growth, from multiple expansion has accounted for so much of the market's return. But you get into periods, the last big inflationary period, dividends can be a big component of your return. So here's a chart illustrating that. This shows, this next two charts, they come from Fidelity. But this shows the average annual return by decade for the S&P 500, and it breaks it down to price appreciation, which is the green part of the bars, and then dividends is the blue part of the bars. Now, like I said, you look at the right-hand side, the 2010s and so far in the 2020s, it's been all about price appreciation. But look at periods like the 1960s, 1970s, the 2000s more recently. You can see that blue bar was a big component of your return during those periods. And so when you look back overall, for this entire time frame, the average annualized return for the S&P is 10.3%. Well, dividends make up about 4.1% of that. So dividends are right around 40% of your total return. So that's the importance of dividends to remember now. Like I said, not all dividends are created equal. There's two types of dividend strategies to look at, and one's much better for an inflationary environment, and that one is with dividend growers. Companies that historically have shown an ability to grow their dividends over time, those are the ones that tend to outperform. And here's a chart illustrating that. Outperform during inflationary environments. So this chart, this looks at the relative performance of stocks that are growing their dividends relative to the rest of the market and how they perform during different inflationary environments. So this study took, it ranked out the inflationary environments, broke it down into 4 quartiles. The first quartile was the lowest inflationary environment. You can see dividend stocks didn't do much then, relative performance of, plus 0.03%. So pretty much in line with the market. Same thing when you go to the next highest quartile, actually underperforms a little bit. When you start seeing these higher inflationary regimes is when you start to see dividend growers really start to outperform. So Q3 plus 1.7%, and the fourth quartile, the highest inflationary environments outperforming by 3%. And a reason for that is likely because companies that can grow their dividends, you're able to help maintain your purchasing power versus fixed income, as the name implies. I mean, you're receiving with a bond a fixed coupon payment, and if inflation takes off, you're seeing your purchasing power get eroded. At least with dividend growers, you're able to maintain that to an extent. Now, the group that you need to be cautious of is high dividend yielding stocks. So you have dividend growers, but then you have stocks with high dividend yields. Well, a lot of times those high dividend yields, especially if they're not growing their dividends, can become like bond proxies. And then we can see what inflation is doing to the bond market right now. And just to give you an example of this, utilities is frequently seen as kind of a bond proxy out there, in terms of the stock market sector. Well, look at the year-to-date return of XLU, which is the utilities sector ETF, versus the S&P 500. Utilities has a reputation of being a defensive sector. It should hold up when things are bad, but it's matched the year-to-date decline of around 6% on the S&P. And I think a big part of that is because of what inflation is doing to interest rates, how that's impacting bonds. You're seeing the same thing with utilities.
Well, let me stop you right there, Clint, before you go on, because I just want to connect it to what you said earlier. You said that dividend growers are the ones that do the best. In other words, that's right. Companies that can grow, and that's the problem with utilities. It's very difficult for them to grow their dividends because they usually have fixed pricing contracts with the consumers, whether they're co-ops or whether they're government or whatever. So that's a critical thing, and I think that's worth repeating. Because if in an inflationary environment, the bond proxy is going to be the company that can actually outpace, and that's not the case with utilities.
Right. So, and then the last thing to mention, this is especially if you're going to go out looking for individual stocks for your portfolio, is to consider relative value. Mm-hmm. And what I mean here is, there's a lot of focus, attention right now around how low the S&P 500's dividend yield has become versus where it's at relative to 10-year treasuries right now. That spread has compressed versus a couple of years ago. I mean, the S&P back in 2020 at least, enjoyed a large spread over the 10-year treasury yield. That spread's going away. But when looking at individual stocks, you can still find that relative value. And just to give you an example, I pulled a stock that we've recently added to the Bauman Letter's endless income portfolio and plotted its dividend yield minus the 10-year treasury yield over time. So you can see what the spread looks like. So here's that chart. This goes all the way back to 2008. Now, not only has this stock grown its dividends over time, it's maintained its relative value when you look at the spread here. If you look at the average spread over this time, its dividend yield is about on average 3.74%, greater than the 10-year treasury yield. Today, that number stands at about 3.64%. So, maintaining that average, that's an example of being able to find relative value out there in these stocks. Yeah. To play this, if you want to go more the ETF route than looking at individual names, ProShares has a dividend aristocrat ETF. The ticker is NOBL. And it looks at stocks that have a very long track record of growing dividends. That's one place you can start. And of course, look at the holdings in that portfolio if you want to get more specific into individual names. Cool.
And of course, there are other ways you can play dividends. You get the CEFs. That's another one. We, basically we have a couple of those in the Bauman Letter because those are actively traded funds. They pay dividends too. And of course, there are other ways you can do it. There's some very interesting funds that basically own equities and then write call options on them and then generate income from the covered call options. And they often pay very good dividends too. So there's plenty of ways you can earn dividends. And I think it's going to be something people are going to pay attention to, because one of the things that drives up the price of stocks when dividends become a more important part of the equation is not just the dividend itself. They just become more attractive. And so their share price goes up. And so, that's what you're setting yourself up for, is that total return. From my side, I've got 2 ETFs going back to the question of the ability to handle rising input costs and absorb them and pass them on to consumers. One is the FNEC Vectors Morningstar Wide Moat ETF, MOAT. It's got companies in it that have wide moats. And that's basically, as Warren Buffett always says, it's his favorite companies, the ones that have the pricing power, that can absorb rising input costs and pass them on to consumers. And the second thing is, just as a general sort of guideline, and this is I'm really stealing this idea from Goldman, because they put out a research note saying this. They said, look at companies with a market cap about 2 billion or bigger. In other words, they're big enough not to to be subject to the winds that buffet small caps. Look for 2023 projected revenue growth over 15%. And 2023 margins over 20%. So if you go looking for a company and you're saying, well, how do I know one that is likely to survive this environment? Look at those metrics. And I think those are the kind of things we try to do when we make our short list. We start with these kinds of things, and it's something you can do too. Anyway, that's all from us this week. Me from Cape Town, Clint from Ohio, which is probably going to be a popular place to be when the Super Bowl comes around. Hey, Clint?
I hope so.
We'll see, so. Especially on the day after. Hey, yes. When Atlanta won the World Series and I was there, boy, that was quite a thing for a city. So let's see what happens to Ohio. All right, folks, we'll see you again next week. Thank you.